We got your Caterpillar reporting robust demand, including a 33% jump in North American sales from last year. We got McDonald's seeing traffic rise at its U.S. restaurants last quarter, and ServiceNow saw earnings per share coming in 12 cents higher than analysts expected. Here to help us trade them all, Lee Munson, President and CIO of Portfolio Wealth Advisors. Lee, welcome back. Why don't we start with Caterpillar? They got a nice story to tell.
I love Caterpillar, nice blue chip. This is why you buy old economy stocks in recessions. So I love the numbers. Here's the thing. Look how this stock has performed this year and how it has been rewarded for beating estimates. And here's the other thing about sentiment. And by the way, I love that China, it's not a big part of this. It's 5-10% of their sales, and it wasn't absolute horrible. But notice that they went from reducing $300 million worth of inventories at dealers to increasing $700 million in dealers, meaning that they sold a lot more stuff to these dealers on the books, and the bears were quiet. Nobody wanted to point that out. Nobody wanted to needle it. I'm bullish, so I'm not needling too, but I think it tells you so much about sentiment when you can have a situation where inventories dramatically rise and there's not a bunch of gadflies pointing at it. Everybody just says, I'm glad we beat, I'm glad they're still selling, and I'm glad that they can push through those price increases.
Mm-hmm. All right, what do you think, Lee? Is McDonald's also a recession special?
It is. Now, I admit, bull markets can get tiring after about 9 months. And months ago, I was on with you guys talking about McDonald's, about the theory that as people shift down and trade down in a recession, a company like McDonald's will work out classically. Guys, it's so nice that thesis still exists, that some things didn't break in this bear market and are still the same. They're raising dividends. Notice that Europe still was strong. Europe was not a disaster. Nobody's complaining in senior management about the strong dollar, and which I love. It shows you that they know how to manage. And also, we fully wrote off Russia, and that wasn't a surprise on how much money they lost. So this is just classic. I think you want to buy this or a thing like Caterpillar. Don't trade it. Just buy it. Hold it till we're in and onto the next growth market, so to speak. I just love this stuff.
Let's look at number 3, and that is ServiceNow. The stock is jumping. Let's take a look at the stock chart, shall we, Lee, and then get your response to it. As we see, that stock is up 13%. Am I chasing something that's already left the station, or what?
Yeah, it might be short squeezes. It's a ServiceNow. That's my tagline for the day. Here's my issue. For 10 years, we've been sold bill of goods by private equity that as long as you change the company into software as a service and made a subscription model, that you're recession-proof. Okay, and that the debt isn't a problem. I agree with that concept, but that's not talking about the price of the stock. You got a $400 plus stock that's making pennies, a few dimes per share. So if this thing was growing at 20%, give me a nosebleed 100 PE, not 500. And the other thing is, it's not its first day of the rodeo. Most big, large firms already use their HR software. So while they still have some growth, this thing's going to start to moderate. And it's not growth at any price. Again, it's just too rich. And I just would rather find something that's a little bit more realistic in terms of valuations.
All right, Lee. Always good to see you, sir. Thank you very much. Lee Munson.